Welcome to the Deep Dive. We're your shortcut to getting up to speed without drowning in all that financial noise out there.
And it's definitely been a week for it.
Absolutely. I mean, really pivotal moments across the board. We've seen some pretty unexpected volatility in crypto, even for crypto.
Especially with institutional money involved now, yeah.
Right. And then there's these, hidden divergences in the big stock indexes.
Things not quite lining up as you'd expect.
Exactly. And maybe a big macro shift that's, really pointing towards gold.
A lot happening under the surface.
So our mission, as always, is to take this pile of market analysis, your sources, and pull out the key insights for you.
Not just the what, but the why it matters.
Precisely. So you can understand the bigger picture. Today, we'll dig into Bitcoin's strange weekend moves and this critical gap everyone's talking about.
Yep, that IBIT gap.
Then Ethereum's huge breakout could be a game changer for altcoins.
A really historic move there.
We'll also tackle that confusing NASDAQ lag and a big catalyst coming up.
NVIDIA earnings, yeah. That's the one to watch.
And wrap up with gold, why some are seeing signals for a, quote, mega super cycle.
It's quite a setup.
Okay, let's unpack all of this.
Sounds good. It feels like a week where you really need to understand the mechanics behind the price moves.
Totally. It's not just random noise. These things, crypto, equities, gold, they seem connected, don't they?
They definitely feed into a larger narrative, yeah.
Okay, let's kick off with Bitcoin. That weekend dropped, what, $6,700?
Yeah.
That felt pretty unusual for Bitcoin these days.
It really was, especially now that it's seen much more as an institutional asset. That kind of weekend volatility is less common than it used to be.
So why was this drop such a big deal?
Well, the critical thing was the timing. It happened while the IBIT ETF was closed.
Ah, right. The institutional gateway.
Exactly. It acts like the main institutional cash index for Bitcoin. So Bitcoin itself was trading, dropping.
But the institutional reflection, IBIT, was offline.
Precisely. And that created this massive market inefficiency and an open gap on the IBIT chart.
Between 67.88 and 69.89, right?
That's the one. And a gap, especially a gap down on a 3-week chart. That's a huge inefficiency.
Something the market doesn't like.
The market generally hates these things. It's expected to act as a pretty strong draw on liquidity.
Like a magnet pulling the price back.
Pretty much, yeah. When the New York session opens, the expectation is the price gets pulled back up towards that gap to sort of fill it in.
So the market wants to fix that imbalance. That makes sense. It's like this built-in correction mechanism.
Almost like gravity, yeah. These institutional gaps tend to get retested.
And I hear there's a strategy already playing on this.
Exactly. Because the market dislikes these big gaps so much, it creates an opportunity. A long position was entered around $110,690.
Okay.
And that lined up nicely with a retest of a key support resistance level, $110,530, and what's called a 3-week bullish order block.
An order block. That's like a footprint of big institutional buying.
That's a good way to put it. Shows strong interest at that level. And the target for this trade, based on filling that gap, is $120,000.
Right. Makes sense.
Yeah.
A clear example of trading the market structure. Okay, let's shift gears to Ethereum. Because, wow, that's been making headlines.
Absolutely historic action there.
Breaking into a new all-time high, printing its largest quarterly candle ever. That sounds massive.
It is. It confirms a huge macro breakout. We're talking about a pattern that's been forming for 3.5 years.
3.5 years. Like a coiled spring.
Exactly like that. Think about Bitcoin's 1,000-day consolidation before its big run, when something coils for that long.
The breakout tends to be pretty explosive.
Right. It suggests some really severe upside momentum is possible. The energy is pent up.
So what are the targets people are looking at now for ETH?
They're ambitious. First stop, maybe $5,953. Then you're looking at $7,332. And eventually, potentially $10.
Wow. That really reframes the potential here. But what about the ETH-BTC ratio? How did that play into this, especially for altcoins?
The ETH-BTC ratio. That's absolutely critical.
Why is that?
Because it tells you how Ethereum is doing compared to Bitcoin. And that's usually the trigger for broader altcoin strength.
So if ETH is outperforming BTC,
then altcoins often follow, sometimes in a big way. We call it altcoin season. And right now, Bitcoin is kind of consolidating, moving sideways to slightly up.
Which is perfect for alts.
It's often the ideal condition for altcoins to, really take off, go berserk, as some say.
And there's a longer-term pattern on that ratio, too.
There's this really interesting idea that the ETH-GC ratio itself might have been in a giant triangle consolidation since way back in 2017.
Since the last big alt season.
Exactly. And if that ratio breaks out decisively...
And the coming alt season could be huge.
Could potentially put that 2017 season to shame, yeah.
Okay, but what could stop this? Any warning signs we should watch for?
Sure. I mean, if Ethereum gets strongly rejected here, or if that ETH-HPTC ratio breaks down below key support levels, that would definitely be a red flag.
A reason for caution.
For sure. But right now, the momentum looks overwhelmingly bullish.
Okay, this is where it gets really interesting for a lot of people. If this altcoin season kicks off, where do you even start looking?
Good question. The first place many are looking is Solana as well.
Why Solana?
Well, Ethereum's had its big breakout. It's kind of super extended right now, Solana. Its train hasn't really left the station yet in the same way.
More room to run in the short term.
Potentially, yeah. It looks like the primary asset to start playing catch-up. And the thinking is that institutional money, the treasury capital that flowed into Ethereum...
We'll start looking for the next thing.
And Solana seems like a logical next step. Plus, it already has ETFs trading on the NASDAQ like SLZ and SOLTI.
Ah, the infrastructure's already there for bigger players.
Makes it an easier transition for institutional capital, definitely.
So Solana's set up for that overflow. What about technical targets and the strategy?
Technically, it's showing a nice bullish ascending triangle pattern. Targets look like $350s, $427, maybe $400 plus at least.
And it needs to break its old high first, right? Around $294.
Yep, needs to clear that $294 all-time high. The recommendation is really a long-term spot position. Think about holding it maybe until the end of 2026.
They capture that whole institutional flow story.
Exactly. And there isn't a ton of resistance between here and the ATH, which is also constructive.
Okay, solid case for Solana. Now, what about this XLM versus XRP idea? Using XLM as a higher beta proxy. Can you break that down?
Sure. So XRP and Stellar Lumens, XLM, they often move together, like siblings.
Okay, correlated price action.
Right. But XLM tends to be higher beta, which just means if XRP moves, say, 1%, XLM might move 1.5% or 2% in the same direction. It's more volatile, amplifies the move.
Got it. So more risk, but potentially more reward.
Precisely. So the strategy is use XRP as the alpha, the signal, the one setting the trend.
And then place your bet on XLM, the beta, for potentially more bang for your buck.
That's the idea. There's an active long-term spot position in XLM mentioned, entered at 23 cents.
And the target?
Ambitious target of $1, which from 23 cents is potentially a 316% gain.
Wow, that's definitely leveraging that higher beta. Any other quick altcoin setups worth a mention?
Yeah, a couple quick ones. Sui and Dogecoin, DOGE, apparently have identical swing trade setups right now.
Based on what?
An inside two handle failure. So 2 weeks of consolidation inside the prior range, then a failed breakout attempt. Often signals a move the other way.
But be careful playing both.
Definitely, they're highly correlated. If one goes wrong, the other probably will too. Don't want double exposure on the same idea.
Makes sense. Anything else?
Avalanche, AVX, is showing a long-term accumulation pattern and a really rare inside 8-month candle pattern.
8 months. That's serious consolidation.
It is. Points to a potential 156% return target over maybe 6 to 8 months. It's a textbook pattern on a high time frame.
But Solana is still the preferred institutional play.
Seems to be, yeah. Mainly because of those existing ETFs. Makes it more accessible for the big money right now.
Okay, thanks for that run through the alt landscape. Let's pivot now from crypto to equities, because there's some interesting, maybe slightly worrying signals there too.
Definitely some things to watch closely.
The S&P 500 is up near its highs, looking strong, but the NASDAQ is lagging behind. What's that telling you?
It signals caution for sure. The NASDAQ is, tech heavy, often seen as the leader for innovation and risk appetite.
So if it's lagging,
it suggests maybe there's some underlying weakness the S&P isn't showing yet. And the analysis points towards Microsoft, MSFT.
But Microsoft had great earnings, didn't they?
Stellar earnings.
Yeah.
But the stock is actually having a down month.
So good news was priced in and now profit-taking.
Looks like it. Suggests a correction phase for Microsoft, even with strong results.
How does that create a divergence with the NASDAQ index itself?
Well, the critical thing is Microsoft is making a lower high on its chart while the NASDAQ index made a higher high.
So the index is going up, but one of its biggest components is going down.
Right. It implies the NASDAQ might be getting propped up artificially, maybe by just a few other strong stocks hiding broader weakness.
And this time lag theory. What does that suggest happens next?
It's this idea that the index, the NASDAQ in this case, eventually has to catch up to its main drivers, the alphas, like Microsoft.
So if Microsoft is weakening,
The theory suggests the NASDAQ will likely follow, sometimes with quite a bit of force. It catches down.
any examples of this?
Yeah, the yen carry trade collapse back in July 2024 was mentioned. A sudden shift caused sharp corrections, and the NASDAQ eventually slid hard to catch up with Microsoft's earlier weakness. Any catalyst can be the excuse.
And speaking of catalysts, NVIDIA earnings this week, Wednesday after the close.
That's the big one for this week.
Yeah.
Absolutely key. How the market reacts on Thursday.
That could set the tone.
Absolutely. For the NASDAQ and probably for broader risk assets too, if NVIDIA sells off after earnings.
It could start cashing down to Microsoft, pulling the NASDAQ with it.
That's the risk, yeah. And then there's the calendar.
September.
Yep. We're heading into September, which historically is the weakest month of the year for stocks.
Even in bull markets.
Even in strong bull markets. We saw dips in September 2020, 2021, 2023. Even a pullback earlier this year fit the seasonal pattern.
So a potential catalyst from NVIDIA plus seasonal headwinds, a bit of a double whammy.
Could be, yeah. The outlook is really for a potential volatility spike this month. Sentiment might turn more bearish through September.
Leading to what? A bottom maybe in October?
That's the typical pattern. A low sometime in October often sets the stage for that stronger year-end rally, November through January.
So maybe a time for caution on new long trades in stocks for a bit.
Probably wise to be cautious on new swing longs in the indices until we see how September shakes out, yeah.
Okay, from tech stocks to, well, something much older. Gold. Our sources are hinting at something pretty big here. A mega super cycle. What's behind that?
Yeah, the environment looks increasingly favorable for gold. It's really about the macro picture.
What specifically?
Well, you've got Fed Chair Powell signaling rate cuts, maybe starting in September. That stimulative usually points towards future inflation.
Okay, more inflation pressure potentially.
And you couple that with recent jobs data that was, frankly, extremely bad, shows the economy is slowing down, decelerating growth.
Rising inflation plus slowing growth.
That's the textbook definition of stagflation.
Right.
And in stagflation, gold is historically the asset that shines. It's the classic safe haven for that environment.
So the macro setup is there, but I understand there's also a rare technical pattern showing up.
Yeah, this is interesting. Gold is apparently showing what's called an inside double 2-month candle pattern.
That sounds specific.
Yeah.
And rare.
Extremely rare. Only seen a few times since, 1970.
Wow. And what does it mean when you see it in an uptrend like gold is in now?
It usually represents a major consolidation period right before a massive breakout, a coiling of energy again.
And historically, what kind of breakouts followed this pattern?
The analysis mentioned immediate rallies of, say, 15 to 18% after the pattern broke.
Pretty significant.
And in one case, it led to an incredible 80% rally in just 60 days.
80% in 2 months. That's explosive. But obviously an outlier.
Likely an extreme example, yes. You'd probably need a serious acceleration of those stagflation fears for something like that. But even the more common 15-18% is substantial.
And are the gold miners confirming this potential?
That's another key point. The gold miners ETF, GDX, has apparently already been leading. It broke out back on August 4th.
So the miners are moving ahead of gold itself.
Yeah, suggesting that gold, the metal, has some significant catching up to do.
Okay, given that potential, and acknowledging past performance isn't future guarantee, how might someone position for this?
The suggestion is a high-conviction options trade using the GLD ETF, which tracks gold.
Okay, options for leverage, what kind?
GLD call options, specifically the $320 strike price, with expiration out in December, either the 16th or 31st.
And risk management, stop loss.
A stop loss if GLD itself closes below $300. The target is based on gold futures hitting 3,754.
And the potential return versus risk.
Well, the idea is it offers minimal risk for potentially very high reward. If gold just does that normal 15% rally based on the historical pattern.
The option could do much better.
Right. The option position could potentially see a 100% return. So it's a compelling risk-reward setup if you believe in the stagflationary outlook for gold.
Okay, a lot to digest there across all these markets. So what does this all mean for you, the listener, trying to navigate this?
It's definitely a complex picture, but the connections are important.
Yeah, we've really covered a critical point in time, it feels like. You've got Bitcoin's weird gap mechanics mechanics, Ethereum's huge breakout, potentially signaling an altcoin wave.
Then the caution flags in equities with that NASDAQ divergence, NVIDIA looming, and September seasonality.
All while gold seems to be setting up for a big move based on that stagflation narrative. Understanding how these pieces fit together, that seems key right now.
Absolutely. Context is everything.
And that's what this deep dive is all about, cutting through that complexity, giving you that context, and hopefully some actionable insights.
Helping you see the signals through the noise.
So the final thought for you to chew on, as we look at these potential shifts, institutional mechanics in crypto, macro drivers for gold, warnings in stocks, how does this shape your own view, your perspective on risk and reward in the months ahead?
Will you be watching for those gaps to fill, positioning for alts, or maybe looking towards gold?
Something to consider. Thanks for joining us on the deep dive.